Gentlemen, good morning to you both. Maneesh, I'll start with you. You say that the short-term risks for equities are skewed to the downside. You think we have further to fall?
Yes, I think so. I think, of course, the Russia thing is completely untradeable in a sense. A lot of moving parts there. But I think to focus on what's happening with the Fed, I think the way that the risky assets broadly are viewing it is that despite the fact that we have had a pretty dramatic shift in monetary policy expected, they're taking it relatively well. And I think the reason for this is that they really think that the Fed has things under control, but we are not that confident.
Okay. So, Jim, your take on this, especially given the fact that we are entering this Fed tightening cycle, and at least from a market standpoint, there does seem to be the sense that it's going to be pretty aggressive pretty quickly, at least through the rest of this year.
Yeah, Morgan, certainly the Russian debacle here could be impactful in the next few weeks, no doubt about that. But I kind of think, if you think out over the next few months, that we're getting close to going back up again, maybe to new highs. I like the combination of a lot of fear right now. If you look at any of the sentiment measures, look at investors' intelligence or AAII, they're all way low. You look at the fact that the put-call ratio is up. The VIX has been above 20 or 25 most of the time since Thanksgiving. We've been dealing with correction now since last August. We've kind of had 3 minor ones. I think we're closer to the end of this than the beginning. And as it regards the Fed, what I find interesting is the reason there's so much fear is because we think neither monetary or fiscal authorities have done anything to lean against inflation yet. It's like they don't care, and so they're way behind the curve. But the reality is we have had substantial tightening in monetary growth, fiscal growth, yield curve flattening, and dollar advancing in the last year. A year ago in March, real M2 money growth was 25%. It's now 6%. Fiscal deficit to GDP in March last year was 18.5%. It's now 9.5%. The yield curve tends to twos was 1.6%. Year ago March, it's 45 basis points now, and the dollar's up 8% in the last year. Someone told you, I don't think the market or the economy cares whether the Fed or the Treasury is doing anything. It's what's going on with monetary and fiscal policy, and they're all tightening. If money growth slowed, fiscal growth slowed, yield curves flattened, and the dollar's up, you'd say the inflation environment is going to improve quite a bit. So I think there's a real chance that the things turn out a lot better than feared, and people have to back off their aggressiveness and number of hikes, and that could lead to quite a bit of optimism for equities.
Okay, so I do want to get into what that's going to mean in terms of investor positioning. But first, Maneesh, given the fact that you are more cautious, at least in the near term, how are you advising investors to be positioned here right now? Where do you see opportunities if you do?
So I think the first one is definitely in financials. So assuming that rates continue to go higher at this stage, even though the curve is flattening, what matters for financials right now is simply the level of rates. And as long as they continue to improve, that's one place that they should be okay. Then turning to sort of the more value side of things, one of the things that has been happening is that growth has been suffering, and value should perform well to some extent. At the same time, given the other risks that I'm talking about, I think it's also good to stay in sort of the low beta stocks to some extent. Right? So a combination of high value, low vol financials. And also the last thing is, overall growth stocks have suffered, but the large cap tech stocks, the FANGs, we carved them out separately as a separate sector, just given how big they are, how big the weight is in the overall market. And I think we're relatively constructive on them because they have, aside from a few specific stocks, they have, broadly, they have done pretty well.
I got to hand it to you. You've been doing yeoman's work trying to be constructive on a lot of these shortages that we've seen. You've written about potentially better labor availability. We're watching for better conditions in shipping. Obviously, pricing and auto production may be coming back. When do we finally get some concrete signs of at least disinflation or deflation in goods that would go a long way toward making a lot of those hopes reality?
Talking to me, Carl?
Yeah, Jim?
Yeah, I'm sorry. Yeah, well, I think we're going to get another hot number next month, Carl. For me, it looks like inflation numbers. I think you're going to have to get out probably till April to get March reports that we might start to see, or maybe even May, before you really start to see the headline numbers turning south. Because if these policies that have been tight, they take about a year before they really start to have impact. And we're not even quite to that year yet. That would be the April-May period where it really starts to turn. But we're seeing some evidence. I mean, look at the collapse in Baltic freight rates. Shipping rates have really come off. Industrial commodity prices have now been flat since last October. They're trending sideways. The break-even rates in the bond market, particularly 5-year and 10 years, have been moving sideways now since for several months. So there are some things changing overall, and I think it's very encouraging. Look at how much the labor force has come up of late, and that's just one example of probably the most important supply restraint is labor. And we're seeing a pretty big burst of new labor supply right in line with the decline in Omicron. I think that might be a precursor to what we might see the rest of this year on a lot of supply fronts.
Okay, gentlemen, thanks for kicking off the hour with us, Jim and Maneesh.
Let's turn to Roku this morning. Shares are getting crushed this morning. About a quarter of its market cap is gone. Q4 revenue misses. Guidance was disappointing. Our next guest asked Roku CEO Anthony Wood about that slowdown in revenue and the competitive landscape on the call. This is Wood's response.
The way I think about this is...
Shepard Smith here. Thanks for watching CNBC on YouTube.